Hey everybody, Rob Maurer here, and today we've got a lot going on with a big week for the market, including earnings from GM and a couple other companies, so we'll talk about that. We've also got some interesting comments from Elon Musk, I think some welcome comments from Elon Musk that we'll talk about. We've got news on Tesla insurance, news on EV subsidies in Germany, and a couple other items as well. So looking at the markets today, Tesla following the markets down 3.6% to close at $776.58. While the Nasdaq was down 1.9%, but many other companies kind of in that same ballpark as Tesla. Some reprieve in after hours though. Tesla up about $10 or 1.3% as I'm recording this, with some good earnings, or at least not as bad of earnings as possibly were expected from Microsoft and Google. So we'll talk about that in a second. But in terms of the action today, a lot of the market was a little bit spooked by a warning from Walmart. They gave an update to their guidance. This is very similar to the update that we had previously seen from Target about a month and a half ago, with Target taking actions to right size their inventory. So what that means is marking down things, selling them for cheaper. That's going to be a margin hit. We're seeing the same thing here from Walmart, except even a little bit more significant, I think. So they said that for this quarter, they expect sales to be up 6%, higher than previously forecasted. But they say that that's really being driven by grocery, so a heavier mix of food and food inflation being in the double digits and higher at the end of Q1, they say is affecting the customer's ability to spend, requiring more markdowns to move through other inventory, such as apparel. So that's impacting Walmart. Basically, they've got inventory. It's just the wrong type of inventory for what their customers are looking for. It's lower margin inventory, and that is causing them to update their guidance for the full year. They've now adjusted their earnings per share expectations for the full year to be down 11 to 13%. Which is a really significant drop, and I think Target had actually still forecast for an increase for the year. So we can see some disparity here with the Walmart report, but previously they were expecting full year earnings per share to be up about 1%. So this is a really big change for Walmart for their outlook for the rest of the year, with just about 5 months left. So significant update from them that puts fear into the market on anything related to selling of anything, which is every business. So Walmart, a big company, having a lot of impact there. However, now that we are after market close, we're getting a little bit of that bouncing back, as tech has been not as bad as feared. We did have reports from Alphabet, so Google, and Microsoft, as we had mentioned earlier this week, and they did both miss. So earnings per share for Alphabet came in at $1.21 versus $1.28 expected. Revenue came in at $69.69 billion versus about $69.9 billion. Similar news for Microsoft. They came in at $223 versus $229 earnings per share expected, and fell short by $750 million on revenue. However, Walmart did give what CNBC calls rosier income forecast for the rest of the year, but I think their vision of rosy is relatively loose there, because it sounds like they just reaffirmed their guidance that they gave last quarter. Still, in this climate, that could be taken as rosy, as it seems the market is doing, with Microsoft up about 4% after hours, and similar from Alphabet, up about 5% as I'm recording. So it seems that's helping out the overall tech environment, the Nasdaq as a whole, and obviously that's playing in with Tesla as well. So again, we'll have interesting couple of days here with Meta reporting tomorrow. We've got Ford tomorrow, and then we have Apple and Amazon on Thursday. So interesting week carries on. And of course, probably peaking in interest tomorrow afternoon when we do get the Federal Open Market Committee statements and interest rate decision. As we've talked about, the current expectation is for a 75 basis point increase. So the CME Group tool that we've been checking for probabilities, that's still sitting at about a 75% chance of a 75 basis point increase, and about a 25% chance of a 100 basis point or a full percentage point increase, which is really no different than a couple of days ago. So big day tomorrow with that and a couple of earnings reports. But getting into some Tesla specific news, we don't have as much on Tesla today in the midst of all of this macro stuff, and I think that's maybe a good thing. After all this reporting that has happened, obviously the Wall Street Journal article on that alleged affair, which Elon has denied, that we talked about yesterday, Elon now saying the amount of attention on me has gone supernova, which super sucks. Unfortunately, even trivial articles about me generate a lot of clicks. Will try my best to be heads down, focused on doing useful things for civilization. So I think that's a welcome tweet for a lot of us to hear. There certainly has been a fair share of Elon Musk related attention and drama distracting away from a lot of what is being accomplished with SpaceX and Tesla this year, with the Twitter thing, with selling shares, with all this, all this different coverage that we have seen. And certainly that's not all of Elon's responsibility, but just his personality and his activity level on Twitter has definitely fanned the flames of those things a little bit, which, Elon seemingly realizing here and hopefully adjusting a little bit for. So again, I think that's welcome news to a lot of, Tesla investors, and I think probably just a good thing for Elon's mental health as well. So I'm happy to see that. I still hope he's relatively active, but maybe just a little bit less in some areas, politics and things like that. Sawyer Merritt here giving some great advice, saying the best thing you can do, honestly, is keep killing it at Tesla, kill them with stellar performance and burn the shorts. 2020 was the biggest short burn of the century, yet Tesla is still the most shorted stock in the world. These fools don't know when to quit. So we haven't talked about short interest in a long time. It's not really that relevant to the stock anymore because it is a small percentage of the outstanding shares, a little bit higher percentage of the outstanding float, maybe around 5% or something like that. I haven't looked at it in that long, but it used to be above 50% of the float. So it was massive percent of the outstanding shares. That has declined, but with Tesla's market cap increasing so much, it is still a lot of value that is being bet against Tesla. A lot of that could be hedging. It's always difficult to kind of figure those things out. But anyway, Elon taking heed of that advice and saying, good point, will do. Now, which part of the will do he is replying to here, not necessarily super clear. Keep killing it at Tesla, kill them with stellar performance and burn the shorts, hopefully applying to all of those things. I definitely, I don't think we'll see a short squeeze like we had seen a couple times in Tesla's history. Again, short interest is much lower these days, but certainly, I feel like there's a lot of upside left to be had in the stock. All right, moving on to Tesla Insurance. We've got an update here on Tesla Insurance. So for Georgia, Coverager here, which has been kind of tracking Tesla Insurance expansion, noted that Tesla has filed for a new insurance program in Georgia. It usually takes a few months for that to, take effect. They're saying the effective date here is November 15th of this year. So a few more months yet for coverage expansion in Georgia. But we can also see that Tesla has now expanded their offering that is effective to both Utah and Maryland. So here on the Wayback Machine, we can see what the available states were back in June. And then now today, Tesla's got this updated to Utah and Maryland being added. So a total of 11 different states here, though one is California, and that doesn't have the safety score version or the telematics-based version of Tesla Insurance because California regulations do not yet allow for that. So kind of a different offering there in California, but 11 states in total. If we look at how this is coming together then, just kind of put a quick recap here of where we're at. So it was about 25% coverage in June, not counting California. We're just looking, talking telematics-based version of Tesla Insurance here. About 25% of vehicle registrations covered back in June. Adding Maryland and Utah, that's another roughly 3%, so we're up to 27.6% now. And then with Georgia being added to our pending list, we've also got Florida and New Jersey on that. That's another about 15% of vehicle registrations being covered, which would put version 2 or the telematics-based version of Tesla Insurance after these, become effective at about 43% coverage. If we throw in California and count version 1, the non-telematics-based version, then we're at 54.4% coverage of total vehicle registrations. Not necessarily Tesla vehicle registrations, that's going to be a little bit different by state, but of just the total auto market. So it's really good to see this ramping up. This is a lot higher than even where we were earlier this year, assuming these pending states go through. Basically, Tesla would be doubling or tripling the offering this year, which is really exciting to see that growth and that expansion for Tesla Insurance. All right, next up here, we've got an update from Green the Only. He often is seeing little details in Tesla's software and firmware. So he's talking here about the newest software update, 2022.20.7. This is a non-FSD beta version, but it looks like some of the changes that have been made include to the range prediction calculation or algorithm that Tesla is using there. He says now it's taking in variables like tire pressure and many other vehicles being... Oh, sorry, my mom is calling me. Live streams. But anyway, taking into account tire pressure, energy loss to phone charging, 12-volt accessories, air density, battery heating and cooling, So many new vehicles or many new variables being added to the vehicle's range calculation in the new software, which I actually feel like already does a really good job of estimating my range. When I've used it, I just had a 11-hour drive both ways, so I've been getting a lot of experience with that last weekend. All right, next we've got an update on Giga Shanghai. So Giga Shanghai, Gasgoo is reporting here. They often have insight into what's going on in Shanghai. They are reporting, as we have previously heard, that multiple sources are telling them that yes, phase 2, so Model Y, did resume production on July 17th. So that's like the third or fourth source that we've had say that. And then for the phase 1 downtime, so Model 3, they're saying that will come back online on August 6th August 8th rather, with the work being completed on August 7th. So again, a little bit longer downtime for the Model 3 line. I'm not sure exactly why that would be. Maybe just an older production process needs a little bit longer to be updated. But a longer downtime resuming on August 8th. So we'll take that into account for our forecast. I think this is maybe the second or third source we have seen on that as well. All right, moving into GM's earnings report. This is a really interesting one, and it really highlights how dominant Tesla is at the size that Tesla is. So just as a preface, before we talk about any of GM's numbers, GM is selling almost 10 times as many vehicles right now on a quarterly level as what Tesla did in Q2. So at 11% of the deliveries, Tesla is already exceeding GM's GAAP net income. And I think this is the second or third quarter that this has happened, and it's starting to outpace pretty dramatically. So we know Tesla was at about $2.3 billion for Q2, despite the production shutdowns, despite some of the other impacts that Tesla noted in their earnings, idle capacity in Texas as well, mix of all the things that are impacting Tesla: raw materials, commodities, logistics, all the stuff that we talked about many times. Tesla's still delivering $2.3 billion in net income. GM at 10 times the scale, delivering $1.7 billion of net income. So just really incredibly impressive what Tesla's able to do, and incredibly exciting for what Tesla will be able to do when Tesla rapidly approaches that scale that GM and others are at. So if we look at this was down about 40% from Q2 last year for GM. And we can see here similar trends so that was GAAP net income. If we look at adjusted earnings per share, that was down about 42%. EBIT adjusted margin, or total EBIT rather, down about 44%. So similar trends kind of across the line here. If we look at how that compared to a couple years ago, because obviously with COVID, things have been really bumpy in the automotive industry, so best to kind of get some context from previous quarters. Here we can see 2019 and 2020. 2019 probably the best sort of benchmark. GM was at $1.64 adjusted earnings before COVID happened back in 2019, and now we're seeing them at $1.14. So again, it's not the best to just judge one quarter, but since that's the news that we have, still very interesting to see how those results have come in. A couple other things I want to point out just in their earnings letter. They talked about how they are reaffirming their full year earnings guidance. So that is EBIT adjusted between $13 and $15 billion. So despite what seems to be a little bit of a tougher Q2 here, they're still confident in their full year guidance. So, that could be still taken as a relative positive. And then they did give an update on their EV business. I'm not sure if this is actually new, but they said that going forward, they're going to mitigate risk and drive down costs to help us deliver $90 billion of annual EV revenue by 2030. Now, GM has talked a lot about catching up with Tesla in 2025, making making capacity for 1 million EVs in North America by 2025. We've talked before about how these really aren't realistic targets to be able to catch up with Tesla. You can kind of couch the words in some different directions and maybe get to a place where somehow that makes some sense, but if we just look at pure revenue, which they spell out very plainly here, $90 billion of annual EV revenue by 2030. Tesla in 2022, this year, they do have a shot. I'm not sure if they'll hit it, but Tesla does have a shot at actually hitting $90 billion in revenue this year. Now, of course, that would include energy and services and others and things like that. But Tesla does have a shot at getting there. And certainly over the next 4 quarters, so if we go Q3 this year to Q3 next year, barring some disaster, Tesla should very easily clear that bar that GM is targeting for 2030. So just some helpful context on that. A couple other things that were interesting from GM's report. So they do talk about their inventory. this is interesting to watch because obviously people have been talking about supply chain, inventory crunches, not being able to deliver to demand. Tesla obviously very much in that spot. Other automakers are too. To what extent is a bit of a question. I think GM's chart here is pretty interesting though, because they did divide it up by SUV and non-SUV, or at least they're showing pickups here. You can see that their days of supply for SUVs are extremely low. It looks like based on this chart, they don't give us a great, highly specific axis here, but it looks like it's only a couple of days of inventory, which would even be below what Tesla's overall inventory is. So point being, as we talked about a long, long time ago, not all days of supply, not all inventory units are created equally. Some segments of inventory are going to be in higher demand and more difficult for GM to keep on their lot. So looking at a total inventory number might not necessarily tell the full story of what's going on with their demand. But this is an interesting one to watch. You can see this has been pretty flat. They haven't really been able to get supply of these more in-demand vehicles to where they want yet. But what's going to be interesting is when and if they're able to do that, then what happens with some of these numbers that we're seeing, down 40% or whatever else. Because once inventory comes back, then these supply constraints start to be less of an excuse, and then we start to get a much better picture on what's actually happening. I think we're all confident in that, but there's still reasons that can be pointed to for some of these results that aren't just disruption. So it'll be interesting to follow this is kind of the main point there, but we can see here very low inventory on some of their key products. And then kind of the last thing on their report that I found interesting was just their isolation of Cruise. So we know Cruise just had that milestone of opening up for some rides in San Francisco. Looking at their financials, obviously not generating much revenue yet, rounding down to zero. Of course, that's in billions. So you don't have to round down too far to get to that. But their adjusted EBIT on Cruise, they're losing $500 million here in Q2. For the first half of the year, they've lost almost $1 billion in full. So this is actually pretty significantly draining on their financials at this point in time. And it'll be interesting to see, if GM's not able to recover to their prior earnings levels, or if Cruise starts to lose even more money, how they'll handle that, because it is, if you think about their 1.7 billion in earnings or whatever, this is, a 30 or 25% hit on that number. So I found that interesting as well. All right, a few other items here. We've got an update on electric vehicle subsidies in Europe. So Reuters is reporting today that Germany will be changing how these are structured. This was announced by the economic ministry in Germany. Under the new plan, electric vehicles that are priced below 40,000 euros will receive a subsidy of 4,500 euros. That's down from 6,000 euros currently. And then that would fall again in the following year to 3,000 euros. Obviously, none of those numbers are super relevant to Tesla at this point in time with Tesla's prices, but this next grouping would be. So for cars priced over 40,000 but under 65,000 euros, the premium right now would be 5,000 euros, or the incentive would be 5,000 euros. That will drop to 3,000 euros. So only 60% of what it was previously. And then for vehicles that are priced at over 65,000 euros, there will be no more credit. I'm not sure if that is current or not, but no more credit over 65,000 euros. And that would change to no credit for vehicles over 45,000 euros from 2024. So 2023, Tesla would probably be getting about 3,000 euros on many of their sales, not all. And then in 2024, probably almost completely eliminated, depending on what Tesla's pricing ends up looking like. They're also eliminating subsidies for company cars, so this would be for private purchase only. And they are also, this one actually I think a positive, but axing incentives for plug-in hybrids at the end of this year. So quite a few changes to the structure, but overall significant reductions in the budget that will be funding these EV incentives in Germany. All right, next, we had previously talked about how Oliver Blume is going to be taking over for Herbert Diess at Volkswagen. I had mentioned that I wanted to take a look into some of the history of his comments on electric vehicles in general. The Wall Street Journal has done a little bit of that too. Something that we had previously talked about was how with the European Union, how they're restructuring or changing some of the regulations for 2035 to basically eliminate the sale of emission producing vehicles. So that has been, in the works. It's been largely agreed upon. It still needs to become completely finalized. But as part of the last round of discussions on that, something that did slip in that we did talk about was that as a part of this, there will be a proposal for registering vehicles after 2035 that are running exclusively on CO2 neutral fuels. So that was kind of slipped in. I believe Germany had argued for that. Germany as a whole, obviously, there's probably some disagreement within Germany, but stakeholders from Germany had argued for that. I think another country as well. And something that we haven't talked about but that has been covered is that Oliver Blume, who is going to be stepping into the VW CEO role, he's been reported to have been bragging at some meetings that he was a key component of successfully lobbying for that inclusion of this carve out for CO2 neutral fuels. So, it's something that could potentially be a bit of an out on what this regulation actually looks like. It may not be all that much important when we see how the market actually develops, but it is just kind of like a little bit of a red herring that is sticking out there, and maybe could be some loophole that could eventually be taken advantage of, depending on how this final structure comes to be. And then we've got Volkswagen's new CEO kind of internally bragging about being a part of that change. So Wall Street Journal saying that a spokesperson for Mr. Blume said the company hadn't exerted any influence on the coalition. Mr. Blume apologized for the comments over the weekend, saying, "I chose the wrong words at an internal event. It gave the wrong impression." So I don't know how you really choose the wrong words for something like this. I think it's probably pretty clear that he was in some way at least advocating for this, and certainly not the first time that he has talked about synthetic fuels. We do have a couple of reports or interviews, I guess, that are just posted on Porsche's newsroom here, directly on Porsche's website. One of the questions he was asked at one point was, Porsche is also involved in synthetic fuels and thus has a special role to play in the Volkswagen Group. Why? Blume said, "Looking ahead, there is no alternative to electric mobility in order to achieve the CO2 targets quickly and sustainably." So that part is good. Nevertheless, we have over 1 billion vehicles with a combustion engine on the road in the world today. At Porsche, we think of sustainability holistically. We want to be a pioneer in demonstrating that synthetic fuels can be an environmentally sound approach for vehicles that are already on the road. Methanol from production that is CO2 free, converted into petrol, produced in places around the world where sustainable energy is abundant. Today's engines and infrastructure can be used for this. So the intent there seems positive, saying, okay, it's going to take a long time to convert over all of this 1 billion plus vehicles that are on the road. So if we had, sustainable synthetic fuels that could actually be used with these vehicles, that would help. So Volkswagen and Porsche are going to be looking at how to do that. The intent there seems good, but it's easy to say that is your intent, but in actuality have a little bit of an agenda to continue to support your business of making what he's talking about here, making today's engines and infrastructure, which can, be used by these things. So I think it's a little bit concerning. We certainly haven't heard, at least to my knowledge, comments like that from Herbert Diess. He's been extremely clear about what needs to happen and sort of all in on electric vehicles. Blume has had plenty of good comments, supportive comments of electric vehicles too. There's one even in this answer: no alternative to electric mobility in order to achieve the CO2 targets quickly and sustainably. The Taycan, I think, has been a mixed success, but relatively successful for when that vehicle was introduced compared to what some of the other competitors have been able to come up with. So it's not to completely diminish it, just to kind of raise a little bit of, red flags in terms of what Blume may be bringing and the little bit more accommodating perspective of some of these other things that Volkswagen may be wanting to do with their internal combustion engine business. The other one that I kind of found interesting here was his comments on Porsche, particularly the 911. He said that Porsche will always offer combustion engines, so not really on board with 100% electrification of Porsche, though he has said that that could be, heavily hybridized. to make up a word there, but certainly doesn't seem to be quite as all in as what Herbert Diess was. All right, last couple of things here. I think last thing. So the Mercedes-Benz EQC, this came out, I believe, in 2018, apparently is going to be discontinued. Business Insider out of Germany is reporting on this, saying that they have seen documents that say that they will stop production in May next year of the EQC. So, about four years of selling this vehicle, and it is now going to be stopped for production. I believe this was Mercedes-Benz's first all-electric vehicle. So, even though we had, at the time it came out, the common Tesla killer articles, here's one I found from Automotive News Europe, talking about how the Mercedes-Benz EQC takes aim at Tesla's premium EV dominance. It has met the fate of so many challengers that have not been able to do that in the least. I thought these comments from Daimler CEO at the time were pretty interesting. He's obviously no longer the CEO, but at the time, Automotive News Europe reporting that he had said competitor products might be superior to the EQC in certain respects, but this didn't worry him. Instead, he compared Mercedes models to decathletes, where the sum total of different characteristics combined gave him confidence in the vehicle's positioning, saying, quote, "We don't necessarily need to have the longest range or the biggest battery. The overall package has to be perfect, comfort, safety, etc. I am very certain that under that aspect, we will have the best product in the market," end quote. I don't know. I'm not trying to tease Mercedes or anything, but it puts in perspective comments that we see today. If we kind of go back and look at comments that were made in the past about electric vehicle offerings and how different the reality turns out to be from those comments that were made at the time. So I think more than anything, just a good reminder of, how different reality ends up being than a lot of the comments that are made today. And I think particularly poignant for today's episode with the focus here, or part of the focus here, on GM's earnings and their guidance on electric vehicles. So that is where we'll leave it for today. As always, thank you for listening. Make sure you are subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast. And we'll see you tomorrow for the Wednesday, July 27th episode of Tesla Daily. Thank you.